Topic 2. Foreign exchange. Structure of foreign exchange. The foreign exchange market is the market in which individuals, firms, and banks buy and sell foreign currencies or foreign exchange. The foreign exchange market for any currency is comprised of all the locations, such as London, Paris, Zurich, Frankfurt, Singapore, Hong Kong, Tokyo, and New York, where dollars are bought and sold for other currencies. Exchange rate is the price of one currency in terms of another. Participants in foreign exchange, FX, are widely ranged from central banks to banks, exporters or importers and tourists. Major or active participants in FX trading are as follows. Financial institutions are a diverse category that includes hedge funds and other asset managers, regional and local banks, broker-dealers, and central banks. Relative to corporate customers, financial institutions trade larger amounts and hold FX positions for far longer. Financial institutions tend to be better informed than other end users as they have strong incentives to invest in information acquisition. Corporate customers use FX markets to support the treasury operations associated with their core business activities such as mining, shipping, and manufacturing. As such, corporations primarily use foreign currencies as a medium of exchange, trade relatively small amounts, and hold these positions only briefly. Most corporate customers choose not to engage in speculative FX trading, indeed some firms explicitly prohibit it. Retail investors primarily trade FX spot in the major currency pairs, although the number of emerging market currencies offered is growing. These individuals or small institutions tend to focus on just one or two currencies and to hold positions for very short time horizons, typically under a day. Retail traders should have strong incentives to be informed, since they trade for speculative purposes and employ substantial leverage. Algorithmic and high-frequency traders. Algorithmic trading is a form of electronic trading where a computer algorithm, or program, determines an order submission strategy and executes trades without human intervention. Human involvement is limited to designing the algorithm, or algo, monitoring it, and occasionally adjusting the trading parameters. High-frequency trading relies on their technological advantage to exploit small price discrepancies across different online trading platforms. The time to execute a high-frequency trade is measured in milliseconds. Speed is so essential to them. FX dealers earn income by taking speculative positions, and by providing liquidity to customers. Speculation is typically the responsibility of interbank traders, whose positions are only held open a few minutes or hours, and proprietary traders, whose positions are held open for longer periods. To align the interests of FX dealers with those of bank shareholders, dealers receive bonuses tied to their individual profits and the profits of the entire trading floor, while their individual risk-taking is constrained by position and loss limits. Global custodian banks is large asset managers typically hire administrators or custodians, who track their assets, calculate portfolio values, process dividend and interest payments, buy and sell assets, and settle trades. When they need to trade foreign currencies, real money investors typically do not contact the major banks. Instead, they trade with their custodian, motivated largely by administrative efficiency. The emergence of retail FX trading in recent years was enabled by the development of a new type of financial intermediary, the retail aggregator. Retail aggregators operate exclusively over internet trading platforms, bundling small retail trades into larger trades that can be handled conveniently by dealing banks. Some retail aggregators act purely as FX brokers, matching retail trades with quotes from banks. Other retail aggregators combine a broker model with a dealer model. They match some trades but strategically act as the counterparty for others. Spot versus forward exchange rate. A spot transaction involves the exchange of currencies for delivery within 2 business days. A forward transaction is an agreement to purchase for delivery at a future date, usually 1, 3, or 6 months hence. A specified amount of a foreign currency at a rate agreed upon today. What is known as the forward rate. When the forward rate is lower than the spot rate, the foreign currency is said to be at a forward discount of a certain percentage per year. Currency swap is a spot sale of a currency combined with a forward repurchase of the same currency. A foreign exchange futures is a forward contract for standardized currency amounts and selected calendar dates traded on an organized market or exchange. A foreign exchange option is a contract specifying the right to buy or sell a standard amount of a traded currency at or before a stated date. Interest arbitrage refers to the international flow of short-term liquid capital to earn higher returns abroad. Function of foreign exchange, FX, market. By far the principal function of foreign exchange markets is the transfer of funds or purchasing power from one nation and currency to another. This is usually accomplished by an electronic transfer, and increasingly through the Internet. With it, a domestic bank instructs its correspondent bank in a foreign monetary center to pay a specified amount of the local currency to a person, firm, or account. A nation's commercial banks operate as clearing houses for the foreign exchange demanded and supplied during foreign transactions by the nation's residents. If the nation's total demand for foreign exchange during its foreign transactions exceeds its total foreign exchange earnings, the rate at which currencies exchange for one another will have to change to equilibrate the total quantities demanded and supplied. 4 levels of transactors or participants can be identified in foreign exchange markets. At the bottom, or at the first level, are such traditional users as tourists, importers, exporters, investors, and so on. These are the immediate users and suppliers of foreign currencies. At the next, or second level, are the commercial banks, which act as clearinghouses between users and earners of foreign exchange. At the third level are foreign exchange brokers, through whom the nation's commercial banks even out their foreign exchange inflows and outflows among themselves, the so-called interbank or wholesale market. Finally, at the fourth and highest level, is the nation's central bank, which acts as the seller or buyer of last resort when the nation's total foreign exchange earnings and expenditures are unequal. The central bank then either draws down its foreign exchange reserves or adds to them. Theory versus reality. There are various theories and conceptual arguments on many aspects of foreign exchange. Some of the theories will be covered in subsequent chapters. However, the conceptual framework of Kenichi Omi worth reading. Omi, Kenichi. 1987. What moves exchange rates? New dynamics challenge traditional theories. Japan Times. Reproduced in Omi, Kenichi. 1995. The End of Nation State, the Rise of Regional Economies. Kenichi Omi claimed. 1. There are more attractive non-interest-bearing forex market, stocks, and real estate investment profit-making opportunities for those could reach 50%, which dwarf any interest-bearing instrument. Example. Large interest spread between West Germany and United States did not result in capital flow between them. 2. Exchange rate is ineffective in correcting trade imbalance, because internationally traded goods are not primarily commodities goods, as in David Ricardo and Adam Smith era. Industries tend to cluster to gain competitiveness and flourish as a whole, like aerospace in United States, chemicals in West Germany, camera and consumer electronic in Japan. Besides, it takes a long time to build infrastructure to excel. Hence, once built, currency rate is too temporary to affect corporate decision to relocate. Example: despite currency adjustment of 40% to 50%, United States trade deficit with Japan still not come down. 3. Exchange rate is extreme sensitive to macroeconomics or and various announcement. Reading the mind of currency traders is more profitable than interpreting economic fundamental. Hence, it is the announcement of the fundamental that drives the forex market, as opposed to the fundamental itself. 4. The political paradigm play important role. Example is Reaganomics policy of strong dollar, strong America, and Japan's intention to keep a low yen exchange rate. 5. The world money supply has gone beyond control of any single government. Interlink and active forex empire enables money to travel anywhere and electronically. If central bank tightens money supply, loans can be borrowed instantaneously from abroad, thus making macroeconomic policy less effective. 6. Monetary interlinkage has created dollar-based market elsewhere. Example: US dollar-based trade deficit is nothing but account receivables for the United States that are bound to come back to the United States.